Common theme throughout some of our videos is that you are a small business in the blue collar industry. You are working hard and you are struggling financially. In some cases, you are starting off the job already in the hole because what we find a lot of times is your pricing is the culprit. There could be many different factors that feed into it. And today we're going to talk about some of the things that you can do to take control of your pricing and make sure that you are taking on jobs that are going to generate the profit you need to reach where you want to go. My name is Dan Murch. I'm the owner of Blue Collar Back Office, and we specialize in helping small businesses run their finances, operate clean books, generate the profit that they need, forecast out their cash flow, and in this case, understand their pricing, understanding the things that they need to do to make sure that they are pricing their jobs properly and generating the profit that they need and they deserve. There are a couple of common pain points that we see when dealing with customers and potential customers. Number one is underpricing your jobs just to stay competitive. You want to keep your schedule full, so you're lowering your prices to compete with everybody else that's out there. Not the greatest idea. Number two, not fully understanding what your overhead is or forgetting to put it into your pricing, right? Just taking what you think you're going to spend on the job and tacking up from there and not understanding your overhead and making sure that you're accounting for it. And number three, probably the biggest mistake of all, is simply guessing. You don't really have a firm grasp of your finances, especially the overhead. So you're guessing what it costs you to do the job and then building your price from there. You want to make sure you have a firm foundation to build upon and then build your profit on top of it. In today's video, we're going to cover all of those things. We're going to talk about how to easily understand what your overhead is and easily build it into your estimates and pricing so that you are generating profit. We're going to talk about understanding the actual burden of the cost for your labor. It's not just the hourly rate. You have to make sure you're taking in all of these other things. And number three, we're going to talk about making sure that you are pricing your jobs for value and pricing your jobs for profit and not chasing the market and letting them dictate what your pricing is and when you should get some indications of maybe it's time to raise your prices. Now, issue number one is basing your pricing based off of what competitors are doing, not what your costs actually are. That's a thing that we see happen all the time, or you're taking the industry average. What you really need to understand are what your costs are, what your overhead is. You know, in certain industries, especially in the construction industry, there's all different types of companies. There's big companies, small companies, and everything in between. So a big company with lots of vehicles on the road and lots of employees in the office, they have a big overhead. They have a lot of costs that they have to cover. So their pricing includes covering that overhead and making sure that they're building profit on top of it. A small company could just be a couple of guys or gals in a truck with very little overhead, no office space. They're getting material delivered right to the job and they only have to cover their labor, things like that. So it's very hard for you to say, you know, what you should be pricing your job at just because somebody else is pricing their job that way. First of all, you have no idea what their finances are. Second of all, you don't know if they're pricing their jobs properly, if they're making a profit. So you might be following somebody else down a path that's just going to lead you to cash flow problems and negative profit. So understanding what your finances are and what your overhead is the first stepping stone to making sure that you are generating income and profit for your company. Now, the next thing is overhead. Now, very simply, overhead are the things that you have to pay for no matter what, whether you have one job on the schedule or whether you have 5 jobs on the schedule. Think of things like your rent, your internet expense, your cell phone expense, general liability insurance, office expenses, things like that, things that you have to pay for no matter what. So when you're job costing, when you're building your job and you're thinking about, okay, it's going to cost me X amount of dollars in material and X amount of dollars in labor to do this job, and you come up with, say, an easy number of, it's going to cost me $1,000. It's not really going to cost you $1,000. There's overhead for the company, and you have to make sure that you are building that overhead cost into your estimates to make sure that you are actually covering those costs and then building profit on top of those. It's not that difficult to do. And we'll talk about later in the video, a very simple formula for including overhead in all of your pricing to make sure that you are generating the profit that you need. The next big pricing mistake has to do with your labor. So what a lot of times happens is people forget to add the burden to their labor. So what is the burden? The burden is everything else that comes along with having an employee. So if you think you're paying an employee $25 an hour and it costs you $25 an hour, you are incorrect. you are probably spending somewhere in the area between 35 and up to $40 an hour, depending on the type of company you're in, the type of benefits you offer, things like that. But things like your payroll tax expense as an employer, workers' comp expense, things like that need to be taken into consideration when you consider what your true cost of labor is. Because if you're paying somebody $25 an hour and then you're only building in a price of $25 an hour, or maybe you think, oh, I'll charge $30 an hour and I'm making money off the employee, you're not. Before you even get on the job, you are losing money because that burden of having that employee needs to be taken into consideration. Things like health insurance, 401k match, all of those things factor in to what a true cost is for your employees. So making sure that you understand what that is as you build out your prices is imperative to generating profit. Now, the last thing is just not building profit into your jobs. You're basically just figuring out what it's going to cost you to do the job. Maybe you're taking the burden into consideration. Maybe you're taking your overhead into consideration, but you're not putting anything else on top of it. Again, you want to be competitive with the market. You want to keep the schedule busy. So you're pricing jobs just to land them, just to keep your schedule full, and you're not building in profit into your jobs. The problem with that is, as we've talked about in the past, you're going to have these seasons that are busy and slow. It happens in all industries, in all seasons of life. There's going to be high times and low times. So if you're pricing your jobs to basically break even at all times, just to keep busy and just to say that, my business is growing, I'm generating income, et cetera, when those tough times hit, you're not going to have the profit left over in the company to reinvest, to grow, to cover those tight times. You have to make sure that you're pricing your jobs to generate profit. Typically, you want to shoot for anywhere between 10 to 20%, depending on the market that you're in, depending on the industry that you're in. But if you're pricing your jobs, covering your overhead, and generating a 10 to 20% profit on top of that, you're doing very well. And you're going to have the opportunity to grow, reinvest in your company. When things get tough, you'll be okay. It won't be this big stress point because you'll know that you have built in the profit a long time and things are going to turn back up again. Okay, so now you know what all the issues are that you have to make sure you address. Now what? How do I price my jobs? And how do I keep it simple and not overcomplicated? It's not. It's not complicated at all. You take a look at your business, understand what your overhead is. Typically, we like to look at a 12-month period of time so that you're not just grabbing one short period and it might have a peak or a valley in it. You want to grab a good chunk of time, say 12 months, and understand what the overhead of the company is. Again, those are the expenses that are not directly related to a job. If you generated an expense solely to perform a job, solely to generate income, that's a cost of goods sold. We're talking about your overhead expenses. So again, rent, things like that. So once you understand what your rent is and you have a clean financial statement and you can see here's what my income is, here's my cost of goods sold, and here's all my overhead expenses. The easy formula that we've come up with is taking your overhead as a percentage of your cost of goods sold. This way you can say for every dollar that I spend on a job in cost of goods sold, I know that based on the historical data of my company, I generate X amount of dollars in overhead to keep the lights on. So again, keeping it really simple. If you price out a job and you say it's going to cost me $1,000 between material and labor, equipment rental, whatever, it's going to cost me $1,000 to actually complete this job. And based on the historical data of my company, I know that my overhead is 30%. That means you have to put another $300 onto that job to get to what your true cost is. So in this case, it's $1,300. And then on top of that number is where you want to add your profit so that you're generating profit for the company. So what happens a lot of times is, again, companies say, okay, it's going to cost me $1,000 on the job. If I charge $1,250, I'm making $250 that day. But you're not. You're actually underselling. You would have been better off staying home that day or landing some other job because at $1,250, you're $50 short of actually covering your overhead. Again, these are really simple numbers, but no matter how big the job gets, those equations hold true. And as you're pricing jobs and you want to know, how I'm going to make out on the job, it's a really easy, simple formula to put into practice. At the same time, when you finish the job and you job cost, which we've talked about how important that is, you want to make sure that you're using that same formula. You want to make sure you say, okay, I generated this much revenue and I spent this much on the job. And based on the historical data of the company, this was my overhead on this job. And this is what my true net profit was. So now that you have a better understanding of how you should be pricing your jobs, let's talk about when you might want to be raising your prices. Yeah, raise them up, generate some more profit. Sometimes having a schedule that's packed is not always a good sign. If your schedule is booked out months and months and months at a time, and you're landing every job that you put a bid out on, that might be an indication that your prices are too low. You are undercutting everybody else in the market, and you're only landing work because your prices are low. So make sure that you are reviewing your pricing at all times and make sure that your overhead calculations are on point and you are generating profit into it. Now, as you continue to grow, your overhead is going to increase, right? You might buy a new vehicle, you might move into a bigger space, you might hire some more people to work in the office, something along those lines. So you can't just check your overhead once and then never check it again. Typically, what I do is I review it quarterly. Every quarterly, I grab the last 12 months and I review my overhead to look for any significant changes to make sure that, the company hasn't changed and my overhead hasn't gone from 30 to 35, or in some cases it can drop, your overhead can drop because as you continue to grow your business and your overhead costs stay kind of static, your overhead number comes down. That's how the calculation works. So you also don't want to get to the point where you're pricing yourself out of jobs either. You want to make sure that you're being as accurate as possible and shooting for that sweet spot where your schedule stays busy, you're generating profit, you're able to reinvest in the company, and you're not having any of that cash flow stress. So that's it. Sometimes the biggest problem that people have with cash flow is that they're just starting out behind the eight ball. They're starting out already in the hole because of the way they're pricing their jobs. And if you take into consideration some of those things that we went over today and you review your pricing today, you might be able to make a big difference in how your company is operating and a big difference in your bottom line. Even with the right pricing, if your cash flow is a struggle, it's going to be hard for your business to be successful. You're going to be stressed out. You're going to be constantly looking for where the next dollar is. So once you get your pricing right, in our next video, we're going to talk about the simple cash flow systems that you can put in place for any blue collar company to help eliminate some of that stress and get you to where you want to go. Thank you all for watching. I really appreciate it. Please like, subscribe, leave us a comment down below. What's your biggest pricing struggle? I'd love to hear from you. Thank you all for the feedback so far. Have yourselves a great day.